Hello, it's Rhonda Thomas, and we're just about to do Managerial's Chapter 6 Intro Problems and Basic Problems. And I apologize to my class for my brain just stopped working the other night in class. So I think I need a little more sleep. But anyway, let's see if we can do this again. I'm going to share my screen so you can see what's going on. Okay. Hopefully we'll do a better job this time. Okay, so I've got my spreadsheet open and I'm just gonna take one problem at a time, and that's just fine. So we're looking at this first problem here. I want to make sure we got the high-low method understood. Okay, so high-low method allows you to take data, right? So we have to think about what we're doing here in cost, volume, profit analysis. We have variable expenses, fixed expenses, and mixed. So when we use a little algebra, we can work our way through total cost equal fixed plus variable. Fixed equals total minus variable. Okay, minus, let me spell variable right. Okay, and variable. Here. Okay, and then we can also isolate variable costs by subtracting fixed from total costs. So they've given us this little data here. Total costs and units produced. The units produced is the activity. Okay, you don't look at the dollars when you're trying to figure out what's the high and the low. You're actually going to concentrate on the activity. Okay, so this is the activity. Use activity to pick high and low. Okay, don't concern yourself with the dollar amount. Just look at the activity. Use activity to find high and low. High and low. Okay, and it just so happens that once you find the activities, then you would plug in their costs. Okay, and all right, so here we are. Okay, use activity to find high and low. So if we look here, our biggest one is 3520. So in the high activity, I'm going to put the total costs for $234,080 and the units produced 3520. Now we're going to take, so it says pick the high activity. That's what we did. Now pick the low activity. So the lowest one is going to get subtracted from the highest one. So now when we pick the lowest activity, we need to remember to subtract that amount. So I've got 150,480 gets subtracted from this cost, right? And I'll tell you what I'm going to do. I'm going to move this over here so that remember, these are dollars, right? These are costs. So costs go with it, okay? And then, all right, so then you subtract the lowest activity, the total cost of the lowest activity from the cost. But once again, when you're picking which one is which, you don't even look at the dollars. You just look at it versus activity. So that's why we have 3,520 minus 1,320, and we get a difference in units produced of 2,200. Okay, then we need to put the cost down that's associated with each of those. So 234,080 units here, and then 150,480 gets subtracted. So these are the two numbers we're now going to use to do our, so really the first step in the high-low is to pick the high activity, okay? That really is the first step. So let me put that here. Okay, so this is step one. So you need to be able to put together from a list, if there were 10 on the list, you would go in and find the highest one and the lowest one, and then put in the costs that is associated with it, okay? So that's step one. Step two is using that information that we just found to isolate our variable cost per unit. So if you take the total cost, that's the difference, divided by the total unit difference, you get $38 as a variable cost, okay? So that was the first question. What is the variable cost? $38. Now we're going to isolate the fixed costs. So this is actually step three. So if fixed costs equal total costs minus this $38 times the number of units, right? This is kind of an equation that we're getting started. So then you plug in just stay with the highest. So the highest total cost, all right? Let me put this down. I'm going to redo this. Okay, the total cost here is $234,080. Okay, then we're going to subtract and $38 times. Okay, so we're going to take $38, so minus the $38 variable cost. And we're going to take that times, right, times the number of units, right, which is 3520. Okay, so let's go ahead and keep doing the math here, I think. Okay, so this is cost. Oop. No. Okay, this is cost. This is dollars. All right, and then we want the rest of the equation here. So it's going to go minus parentheses $38. $38 times our units produced. Okay, units produced. And so then we want 3,000, 520, close parentheses. Okay, so that way, and this is a subtraction, right? Got to do a little multiplication in between. So let's just keep bringing this down. We got $234,080, and then this is going to subtract. So we're going to minus. Okay, and then let me. All right, so minus. Okay, I'm going to put equals $38 times 3520. Okay, so there's that amount. That's how it got to be that. Okay, and these are now both dollars. Okay, and now when we subtract, we can find the fixed costs for. Okay, so now we want to isolate the fixed costs, and that's what we're doing here. Okay, so let me get rid of this and all this, trying to make it a little easier. Yeah, that's easier said than done sometimes. All right, so fixed costs is based on what we found. Okay, so equals fixed cost. That's what we're trying to find. Okay, so 234,000 minus, or we just add, okay, because I've got that in as a minus, so we're gonna put these together. We got 100,320 is the fixed cost. So fixed cost, it just keeps going down until you find it. And there now we have found it. So now we're gonna plug in our fixed cost and our new variable cost to understand how the total cost came about, okay? So you're supposed to put the fixed cost in, and mine was $38 for the variable cost, but now we're going to work a problem here that should be for the okay, so if these are the numbers that we have, this is the fixed cost, and this is the variable part. Okay, so I'm gonna take this down one and show that here. So this is fixed costs and variable costs. Okay, and if we take 100,320 in fixed and 133,760, we should balance to the total cost of $234,080. Okay, let's see if that's true. So you just keep bringing the total cost. Okay, so equals that, right? Or the fixed cost up here, fixed cost plus the 133,760. Okay, now be careful because I have that in as, okay, so let's just, okay, so $234,080 is how much, yep, and that is the total cost right up here. So we broke out how much of it was variable, how much of it's fixed, okay? And then I know they didn't have us do this step 3, but it's always good to go back and see if it's gonna work, okay? Because there might be something that you didn't see. Okay, so there it is. There's the total cost. Now I know they're not asking for that in the problem, but that's how you double check that your numbers came out. Okay, so double check the numbers. Double check. Okay, so double check formula works, right? Total cost formula works. Yep. So there you have it. Okay. All right, the next one is number 2, and we need to start getting used to some words. Okay, we're going to learn about the contribution margin. We've seen gross margin. We've seen gross profit. Now we're going to look at an income statement a little bit differently than we have before, and I am going to put in something here. So I want you to be able to put down sales minus variable costs equals contribution margin minus fixed costs equals operating income. Okay, so that's all good. Let me get this out of here. Okay, so this is good to learn. You can also learn this by the unit. So I'm going to move this down. Okay, so let me get rid of it. And we'll go back through this here and make sure we understand. Okay. So we are selling, okay, 38,000 units at a cost of $22. So you might as well go ahead and put sales. And we'll put here how many we sold. So it is 38,000 units. Okay, number of units sold. Okay, so we're going to put this in, but this is not dollars. This is units. I don't think I labeled this in class as good as I should have. So I apologize for that. Okay, so now I'm going to take the 38 out of here so we can have another column. Okay, so let's just call this sales per unit. So they have to be, they have to give us that. And then this is the variable cost per unit. So VC per unit. Okay, that's the dollar value. And then we can get it in total sales, total, right? Then we can get totals going. Okay, so then we'll put totals here. All right, and then the contribution margin. This is the unit contribution margin. Okay, we're going to be using that term quite a bit. Unit contribution margin. It's going to be in dollars. Okay, we're also going to learn one called contribution margin ratio. So don't worry about that one yet. Okay, so and then the fixed costs, we'll put the fixed costs over here because we don't usually figure out how much the fixed costs are per unit. All right, so let's do a little of this math. So let's take 38,000 units times its sales price. So that's 836,000 in sales, and then we want 38,000 in variable costs. Okay, and now we can just subtract these or keep taking it times 38,000. So you have to subtract the variable costs to get your contribution margin. You can get it by the unit or you can get it in total. Okay, so they gave us our fixed cost. Now this is where fixed cost goes. They gave us 116,500 that we need to cover and then some, and whatever's left over after we've covered our fixed costs is operating income. So if we look at doing the math here, hopefully this helps a little more. Okay, so I'm going to put this in the middle because I don't think I did a very good job teaching you the labels of these things. Okay, so all right, and I'm also going to show you how you get these contribution margin ratio. All right, so let's do contribution margin ratio. A ratio is a percentage. Okay, so a contribution margin ratio. Okay, so this is going to be a percentage, and it has a formula. Okay, so when you're looking at sales, you can also find out what percentage is, and you'll want to get used to doing this. So your sales is going to be your 100%. Okay, so you can either do it by its sales price or the total. So if I do sales divided by sales, then I get 100%. Okay. Then I want to do variable cost divided by sales to see what its percentage is. And now these two must add up to 100. Okay, so I'm just going to keep doing what I was doing. So contribution margin then is 41%. Okay, 41%. And so you're going to need to keep this going. This is your contribution margin ratio. Contribution margin ratio. Okay, so when they ask for that, there it is. Okay, so yep, that's why that's sitting there. And they said to do it in a whole number. Don't take it past, don't do any decimals with this. Okay, so we're going to highlight this one. Okay. And then, so that explains that. And then this is the unit contribution margin. Right. So for every unit they sell, they bring in $9.02 that will help cover fixed costs, right? Fixed costs. Okay. So there are some formulas for this. Okay. So we're looking at, just depends on what you're comfortable doing. Okay. If you get kind of confused easy like me sometimes, I just kind of commit it to memory and try to plug it in. Right. So you can take the contribution margin divided by sales. Okay, contribution margin ratio is contribution margin. This is the contribution margin divided by sales. That's what gets this right here. So contribution margin ratio is contribution margin dollars. Yeah, contribution margin dollars. Okay. Not units, but total. Yeah, total contribution margin. I'm just showing you another way you can get it. So let's see. Total contribution margin dollars divided by, okay, divided by sales. Sales. Okay, so if we did this to show you the math here, you would take 342,760. Okay, and then you're going to divide it by sales. Okay, so sales is 836,000. I know I've already done this here, but I'm doing it one more time. All right, so now this divided by this, and this is your total contribution margin divided by your total sales. Okay, total sales dollars. I'd like to try to put dollars when they're dollars. But you don't get confused, hopefully. Okay. All right. And this math also comes out to 41%, I believe. Yes. Okay. So we just reconfirm that one. And then they want the unit contribution margin rounded to the nearest cent. So when we do the subtraction here, this is the unit contribution margin, but just for us to, what we're trying to find is unit contribution margin. And this is in dollars. Okay, so unit contribution margin, and these are dollars here per unit. So you could say sales dollars per unit. You could put variable cost dollars per unit. And then our actually it'd be contribution margin dollars per unit. And they like to call this one unit contribution margin. So watch out. Okay, so how you figure this is your sales dollars per unit. You could say unit sales price less the variable costs, right? Unit variable cost, unit variable cost. Okay, that's one way to do it. So it's 22 minus 1298 gives you your unit contribution margin. All right, and then the last one is the operating income. So C is operating income. And this is where putting a little table like this together should be helpful. This is fixed cost operating income. So operating income, okay, operating income is contribution margin minus fixed costs. A contribution margin minus fixed costs. You say, how did you get this one? I just subtracted it. Now these, I just took times, so $22 times 38,000 units that they sold. $12.98 times, whoop, nope, let me go back. Yeah, you got to make sure that when you calculate units sold, so I'm going to put units sold right there. Okay, and you can just put it in one spot because you got to do that also for variable. And then when you do the math, right? So this is 38,000 times 1298. Okay, and then you know that the variable cost gets subtracted first to find out what our contribution margin is. And so we have this much contribution margin, and then we subtract the fixed costs. Okay, so subtract the fixed costs, and we can find our operating income. Operating income is 226,260. Okay, 226,260. So another way to calculate operating income, I've just put total dollars, right? The contribution margin minus fixed costs. Okay, so you got to figure that stuff up above first. So contribution margin, that's total. Less fixed cost. Yep. That is what operating income is. So I'll put an equal sign before that, and then you should be able to see it. Okay, so if they ask, some of these you have to practice. Okay. Okay, I'm going to put a little asterisk in front of it so it'll stay put. All right, there are the formulas for that. Okay, now we're moving on to break even. Okay, the idea of break even is that the revenue that you bring in covers your costs. Okay, so I'm kind of starting this over from scratch so that we can make sure that I'm following better. So we get rid of those. All right, I'm going to use this because I kind of like how I set this up better. All right, so I'm just going to bring it down and start over with a new problem. Okay, now there are formulas for breaking even. Okay, so it's okay to use those too, but you should be able to prove that you have zero operating income if you sell a certain number of units and a certain dollar value, then you should be able to prove. And I think proving the break even is very important, because just when you think you understand, you don't. Okay, going on. Okay, now notice they don't tell us how many units, because that's what we're trying to find. Okay, so I'm going to take that out. Let's find out what they're telling us. They sell a product for $76. Okay, the variable cost is 52. All right, and fixed costs are 95,040. Okay, so here we sit. Okay, we can go ahead and do our percentage of, okay, so even if you don't have the, even if you don't have the number of units yet, you can take, this is sales divided by sales. Yeah, there's your 100%. And now we want to divide, we want to take variable cost and divide it by 76. Okay. And then for the unit contribution margin, and this is dollars too. Okay, unit contribution margin. So they don't necessarily want this. I'm gonna get rid of this. Okay, but it is good to keep this going, so you have it in your mind. Okay, so then we have our contribution margin percentage is going to sit over here. Okay, contribution margin percentage. So okay, so you can just subtract 68 from 100, which is the easiest, or you can do it the hard way, $24 divided by the sales price. Okay, so either way, this is our contribution margin ratio. Okay, now we're going to get ready to break even. Okay, break even. Well, breaking even means that our operating costs, our operating income is zero. Okay, it's zero. And we put our fixed in here. Okay, so to find the break-even point in sales dollars, let me give you the formula. Break-even point in sales dollars. So in sales units, sorry, break-even point in sales units. How many units? Okay. Okay, we're going to find that, right? And okay, and then the other one is the break-even point if the selling price were increased to 85, and we'll do that with a whole new deal here. All right. So what we have to do is if this is going to be zero, then we know contribution margin has to be zero, right? Yep. Okay. And if this is part of this is 24% of that, we can find how much the sales dollars are, or let me go to the book. Let me show you the formulas. Okay, the formula for our break-even point is fixed costs. Now this is in sales, okay, in sales dollars or sales units. In sales units, yep. So we're going to take those fixed cost, and divide by the unit contribution margin. Yep, it's the dollar value. Okay, fixed cost divided by unit contribution margins. Okay, so now I'm going to bring that down here. So our fixed costs are 95,040. And I'm going to make this show up instead of, right? So I'm going to show you my formula here, equals fixed costs. Okay, so fixed cost is $95,040. Okay, and then we're going to divide that by unit contribution margin. Okay, sometimes it's easy to get mixed up. So now we're going to divide by $24. Okay. So the number of units that we need to sell is, I'm going to do this one more time, and then we're going to divide by that unit contribution margin. So these are units, not dollars. Okay, so we do not want dollar signs. Okay, so this is the break-even point in sales units. Okay, sales units. That's what we need. Now, sometimes you can find sales dollars. Well, how would you find out what the sales dollars are? If we took 76, the price of $76, sales price times 3,960, we could put this in. So that times the sales price, yep, $9,060. Okay, and now we can find our variable cost if we needed to, right? Which is the sales minus the contribution margin. So there is your variable costs. And if you work the math, yes, when sales units are 3,960, right? So this is sales units, unit sales, sales units. Yeah, sales units. Okay, I'm using what I just found down here, and then I'm testing it. Did it work? Yes. Okay, the break-even point in sales units. Okay, you can also find break-even dollars. Okay, now sometimes they'll want you to do this, sometimes you won't. Right, I'm just going to put break-even point in sales dollars. So one's in units and one's in dollars. So the formula for that is to take the fixed costs divided by the contribution margin ratio over here, not this unit contribution margin, but the contribution margin ratio. So once again, it's fixed costs are the numerator divided by contribution margin ratio. Okay, that's going to be a percentage. Yep. Okay, let's keep going because I want to make sure I get this. All right, so then this is going to be equals $95,040. Okay, so let me put that in. $95,040. Okay, now we're going to divide by 32%. 32%, or change it to a decimal if you need to, or 0.32. Okay, and I just want this to display. I don't want them to fix it. I just want you to see what I'm putting in. And so now I'm going to test it. Okay, so now, you could easily just take your units times your sales price, but I also want to show you that you can find it this way too. So then we take the fixed and divide it by our contribution margin ratio. And hey, there's the dollars that we just found. Okay. All right, now we're going on to B. Okay, B says that what if we took this analysis and stuck in a different sales price? Okay, so now that we've kind of got this down, let's see what we can do. Okay, so I'm going to put this down here. We don't know how many sales it's going to be. All right. We still have $95,040. This time, the sales price is going to be $85. Okay, $85. So that changed this a little bit. This is the unit contribution margin, and it changed the contribution margin ratio too. Yep. So now the contribution margin ratio just went up 7%. Okay, so that means that they're holding on to 7% more of their sales dollars to cover costs. And now we want a break even. Okay, so once again, we're going to take that same fixed cost, but now we have a different unit contribution margin. Okay, so I do want to highlight. So this changed. If you do it side by side, then sometimes you can see the change a lot better. So when we divide this by $33, because that's the contribution, right? Let's do the math. So let's take our fixed divided by our unit contribution margin, and there's 2,880. All right, so I'm going to put that number here. Okay, 2,880 in break even point in sales dollars, right? Okay. All right, and then we could have done the same thing. We could have found the sales, right? And we have to divide by 39% or 0.39. Okay, so I think I might be getting my brain back a little bit, but I don't want to say anything. Ooh. Okay, so there it is. And it produced the amount we expected, right? Okay, and this is I didn't finish labeling these one more time. These are the in sales dollars, right? Break even in sales units. Let me say it right. Sales units. How many do we need to sell? This is your break even in sales dollars. Break even in sales dollars. Okay, so that's why I try to label what we have. All right, maybe that's a little better. Okay, now we're going on to the target profit. Well, kind of use some of the same idea here. Okay, so I just did that one. And I can get rid of this. Okay, so let me just get rid of this. And all right. So we're going to use this. I like this one because it lists this out for us. So I'm just going to use this because you're going to have to find out what the break-even point is. You have to know what the break-even point is before you get to figuring out adding a target to it. All right, so that has to come first. Okay, so this is number 4. Yep. Okay. Number 4. Okay. So once again, I'm going to grab all of this and try to change what I need to. Okay. So okay, this one says sells a product. So I'm going to take out sales units. I'm going to take all this out so that we can find it. Okay, take it out, take it out. Okay, so the sales dollars per unit is 205. The variable cost is 70. So that leaves us to do the math to find the unit contribution margin of $135 a unit. Okay, our fixed costs are over here, 999,000. Yep, that is going to go there. I'm not putting that in yet. Okay, so now let's walk this through. Break even point in sales units. So that is not what we want, or at least not yet. So what we need to do, be careful. Now we need fixed costs, which is 999,000 divided by $135. Yep, so equals. It's okay to make sure we know. Equals 999 divided by our unit dollar contribution margin. Yep, by 135. Okay, so this is going to get us our break-even point in sales units. So we'll do the math. All right, so yes, 7,400, even though that was the number we had before, I just wanted to show you now, we're going to put 7,400 here. And we're going to go ahead and test this out to see if it works. So if we sell 7,400 units times its sales price, we should get our break-even sales dollars. 1,517,000. Okay, so the variable costs are 34% of this, or it is 7,400 units times variable cost per unit, 518,000, right? And if we do the math right, here's the sales minus the variable costs. There is where your contribution margin matches up equally with your fixed costs. So we know we found the right break-even point in sales units. Break-even point in sales units. Yep. Okay, now we're going to look at adding a profit amount to this. Okay, so let me bring it down. We now know what our break-even is, right? So we know that this option to achieve a profit of $309,000 and $309,690, we know that's going to be more than that number, right? It takes more units to get past to break even, right? To get past break even. All right, so what I'm going to do is I'm going to take this and bring it down. Okay, so now we don't know what it's going to be. Our sales price stays the same. So all this is the same, and so is this. But now we want 309,690 down here. Okay. So when you add these two together, that should be the contribution margin. Okay, so if you add them together, you'll find out what contribution margin is. Okay, Let me also give you the formulas for target profit. Okay, target profit. Okay. That way, sometimes it's okay to rely on a formula. Okay, sometimes it is. All right, so by the way, that was what we found here. Okay, and then we needed the break-even point in sales. Okay, break-even point in sales. Make sure to put that break-even, that was from before. Break-even point in sales units. Okay. All right, so now we have a target. Okay, so here comes the formula. All right, we are going to, so just like we did this, now we're going to add target profit to the fixed costs, right? So it's going to go target profit plus fixed costs, okay, divided by unit contribution margin, okay, unit contribution margin. So let's just do the math here. So our target profit is right there. Okay, I'm going to add 999,000. Okay, and then we got to divide by $135. Okay, so there it is written out. Okay, so now let's just do the math here in Excel because we're trying to find the break even in sales required for the company to achieve. So break even sales units, this ought to be the target profit sales units because the break even was up here, but this is how much extra, or this is how much needs to be there to have this kind of a profit. If this gave us operating income of 0, then actually you can just take your target profit and divide by 135. 135. Yep. Well, that's okay. Let's just follow what this says. All right, so here are, okay, and I need to put sales dollars here. There we have it. Okay, so now this amount divided by 135,000. So this is these two added together, which I know we've already got that. There in that. Okay, there it is. Wait. Okay, that's not true. Okay, so if I wanted to know the break-even units was 7,400, so you would take 7,400 times okay, so the sales is going to be, all right, so we know this is our fixed and this is our target. So these two added together is 1,308,690. Okay, we're going to divide that by 135. Okay, so now the answer is, okay, this divided by this is 9,694 units. We just got units, not dollars. Okay, and it says that's what we should put in. Okay, so this is break-even point in sales units required the company to achieve a target profit of 309,690. So this is break even in sales units. Okay, sales unit. Okay, and we're not breaking even. We're making $309,690. Okay, that is not breaking even. Breaking even is zero. Okay, but back up here, breaking even was selling 7,400 units at this price. And now we're going to test it. Okay, I'm going to test it. So equals this amount right here. Yep. So then our sales units times our sales price, right, gets us that. Here is our variable cost, because we're taking the sales units times the unit variable cost per unit. And then we can do the math here for a contribution margin. Oops. Okay, so the math is 13,08690. Yay! And then we subtract our fixed, and there is our target profit. Okay, so I'm going to put target profit. So we just proved it. Okay, but this is the answer that they want. Got to figure out how many units we have to sell to have a profit like that. Okay, so let's go ahead and check it. All right. Okay, this next one is sales mix. Okay, sales mix. So if you have more than one product, then what do you do with break even, things like that? So let me get ready to do this. Okay, so this is number 5. Okay, and then I'm going to pause for just a second. Look here. Okay, where's my pause? Pause or stop recording. I just want. Okay, we're back and ready to finish the last 4 problems in this introduction to chapter 6. Chapter 6 is cost, volume, profit analysis. And I'm going to share. Okay, I've shared my screen. Okay, we're ready for the number 5. Okay, number 5 is called sales mix. So sometimes, and the break-even analysis. So sometimes, well, companies have lots of products, so they have to figure out how much of their sales is of that product compared to the rest. Okay, so here's what I did. They have 2 models, 2 products, tab and back, put their selling prices down, their variable costs, and then their unit contribution margin, and mine is showing 75% goes to tab and 25% goes to back. So what you have to do, it's kind of difficult, but you have to take, for the selling price of the mix, you have to take this selling price times 75% plus this selling price times 25%. Okay, that's how you do it. So here it is. So the selling price is 260 times 75% plus 400 times 25%. When you get those two numbers, you add it together, and then the mixed sale price is $295. Okay, and you do that for the variable costs and the contribution margin. Okay, so when you know what your mixed contribution margin is, which I've got 115 here, then it tells us the fixed costs. And so break even in sales units of 874,000 fixed costs, going to divide that by 115. This is our break even total units. Okay, break even total units. And then tab gets 75 and that gets 25. Okay, so yeah, I opened the spreadsheet and it took a little bit, but there is the first number is the fixed costs divided by, and then we have to take the percentage of, and this is all about contribution margin. So it doesn't really have anything to do with these two other than that's what this calculates to. And then the percentage is here. So we took this times 75% plus this time 25% times 75% of the whole thing. So remember, our break even is 7,600 in total units, and 75% of that is going to be going to tab, and 25% of it's going to go to VAT. Okay, so I got 5,700 and 1,900. That one took a little bit. Okay, closing and moving on. Okay, now we're getting to operating leverage. Okay, operating leverage is pretty simple calculation, but sometimes it's kind of hard to understand. It's used to measure the impact of change in sales on operating income. For example, the higher the leverage number, the more the change in sales, either up or down, impacts operating income. So for example, we have 401,700 in contribution margin, and we have operating income of 85,500. When you take, this is the numerator and this is the denominator, then I got 4.7. Okay, 4.7. So what that means is that, for example, we had a 10% increase in sales. While sales go up, because the leverage is 4.7, you'd see a 47% increase in operating income. So this becomes a magnifier of whatever is happening, and it can go the other way too. So if you had a 10% decrease in sales, you would have a 47% decrease in operating income. Yep. So that's like the magnifier of the change in sales. Up or down. Okay, number 7, this is the margin of safety. Margin of safety is, what is the break-even point? Let's record the sales. So we have sales of 224 million. We subtract the break-even sales dollars, and there's the margin that we have. That's the extra inventory, or that's the extra sales we did beyond break-even sales. Okay, and then we need to know what a percent is of this margin to sales. And right now it's 23%. So whatever you get when you take sales and subtract break-even sales dollars, you get a margin. And then you're going to divide it by sales. So current sales may decline 23% before an operating loss occurs. Okay, and then this last one is another sales mix. Shouldn't be too bad. I just put in the new prices, the new selling prices, the new variable costs, the new unit contribution margin. This one I have is 35% and 65%. Okay, the break even. No, the fixed costs are 867,300. We're just gonna concentrate on the contribution margin, and we need the mix, right? So the mix is 35% of that and 65% of that added together. Okay, so when we divide our fixed costs by contribution margin, we get a break even of 4,900, but that's not the end of it. So then this is the break even units. So I'll just put that down here, break even units. Okay, and that's not dollars, that's units. Okay, so, and then we need to take 35% of that goes to this product and 65% of it goes here. These two must add up to that. Okay, so thank you for being patient with me. I had to go back through a few things to make sure I understood how they were teaching it. So I'm going to say goodbye for now. There'll be another video up probably well, it'll be up tomorrow. So, but I'm going to get this one up just as soon as I can. We will say goodbye. Have a good one.